Hello and good afternoon, everyone. We're glad to welcome you onto this webinar this afternoon, which is part one of the Enterprise Value two-part series. It's great to see so many attending, and we're looking forward to really unpacking the meaning of business value and what the key drivers are behind this. We get involved in a lot of business valuation work, and we do find a lot of recurring themes, some of which are positive, some of which are not so. So we thought it would be a good opportunity to share some of those with you, and more importantly, how to use these to great effect to influence and increase the value of your own business. We'll also be sharing some exclusive information that's not readily available on the internet, which we're sure, like us, you'll find it very insightful and helpful. If anyone has any technical issues, feel free to contact us using the chat function. A recording will also be made available afterwards, so if you have any issues, you can watch this again afterwards. Part one is an informative session, so there won't be a Q&A at the end of this session, but feel free to post your questions in the chat box or the Q&A as we go, and we'll aim to address these in part two. Joining me on the panel this afternoon is Joe Brewer, consulting partner here at Oldfield. Good afternoon, Joe.
Yeah, thank you, Jerry, and hello and welcome to everyone joining the webinar. Great to see so many joining. Timing this webinar is actually quite good because we've just had a fresh release, haven't we, today of some more data for obviously business sales going through for May 22, so just last month. So it's actually, we're looking forward to sharing some of the insights and data that's available. Thank you, Jerry.
Thanks, Joe. Well, you don't need us to tell you that we live in pretty turbulent times, and there's no better evidence of that really than in the M&A marketplace. Particularly when the pandemic hit in March 2020, as we all know, billions of dollars of deals were put on hold, and it did feel like things were going to grind to a bit of a standstill. But the interesting thing is that the recovery from this was a lot quicker and sharper than many expected, unlike the financial crash of 2008, which you'd all remember well. And we just thought we'd share this graph here. This is not our making, but it's an interesting graph here, just showing the total deal values globally over the past 20 or so years, and you can see in the 07, 08 or 08, 09 time there's a very sharp dip in deal volumes, and that only came up again quite slowly. The interesting thing is that fast forward to 2020, you can see that there was a much smaller dip and it's recovered much faster, and in actual fact 2021 was a record ever year in terms of total deal values at $5.9 trillion US, which out of interest was the first time I believe that deal values topped $1 trillion every quarter in 2021. So some interesting numbers there. The next graph just drills into the detail a bit further, quarter by quarter, and I guess from this we can see that 2022 hasn't got off to a great start with the war in Ukraine, which is, as we all know, fueling supply chain issues and inflation, and that in turn is driving up interest rates, which is going to have a knock-on impact in terms of the cost of financing new deals. So we can see that from the last quarter of 2021 through to the first quarter of 2022, there's actually a 25% drop in deal values. But this is still, if we look back to 2019, which you can see on the left-hand side of this graph, it's still above pre-pandemic levels. In the latest data, which has just been released for May, we can see that deal activity did decrease again in May 2022. representing the second lowest month by month volume over the last 12 months. But the good news is, and I guess the thing to remember is that there's still a lot of good stuff happening out there, and UK companies are continuing to attract cash-rich buyers, and May is no exception to that trend. So there's still an awful lot going on. Drilling down a little bit further, the lower end of the market, which would be more familiar space for many of us, it's interesting to see the similar trends. 2021 being a record year, but the dip seems to have happened a little bit sooner, with the last quarter of 2021 being at very similar levels to the first quarter of 2022. So you might be thinking right now, well, why is this important to me? I'm not in the business of serial buying and selling of businesses. This is outside of my world that I operate in. But I think there's a number of good reasons why it's important to have some understanding of what's going out there, even if you're not, involved in it day to day. Firstly, it tells us about what the key global trends are for products and services. It informs us in our own acquiring and selling decisions, even if they're on quite a small scale, so that we can get an idea of what's happening in the marketplace, and therefore what we can expect to happen in our own situation. It gives insights into what's ahead in what's very uncertain times, and there's the market is a very good indicator. The investment market is a very good indicator of what's happening out there, what the general feeling is, and it also provides a window for opportunities on growth sectors. And there's certain sectors that are performing very, very well at the moment, and if we're aware of what those are and can tap into those, that's a very, very useful thing to be able to do. So with that, I'll just cover off on our brief agenda for today. Firstly, we're going to be talking about how business value works. Secondly, the impact of size on business value. And then what an acquirer looks like and what they're looking for. And just rounding off with some real life case studies, which I think you'll find very interesting and will hopefully bring it all to life. So I'll hand over to you, Joe, to talk about business value and what impacts this. Thank you.
Thank you, Gerry. So we're now going to look at how business value works. So some will be familiar with the concept of it, might be new to others. But really, in other words, this is how we value a business, or how we calculate how much a business will likely sell for. So business value is usually calculated by multiplying what's known as EBITDA, and we'll just summarize that in a moment, by a multiple. So if you multiply the EBITDA by a multiple, you arrive at total business or enterprise value. EBITDA, as many will know, stands for earnings before interest, tax, depreciation, and amortization. So that basically what that means is it's the net profit of a business before tax, interest, and depreciation are deducted. So having got the EBITDA of a business, you might say, well, yeah, that's easy then, I'll calculate business value. But it's not quite as simple as that, because firstly, it's really, really important to normalize the net profit. And really your accountant can help with that. For example, excluding non-trading or exceptional items out of the profit before you arrive at the EBITDA. Then how do you use EBITDA to arrive at business value? Well, having calculated and normalized that EBITDA, you then times that by a multiple, and then often you adjust that for cash and debt, which is an exercise that's needed to arrive at an accurate value for your company. So, for example, if a business has got excess cash or excess debt, that could distort the value. So it's important that you don't just use the EBITDA times a multiple without making that adjustment. So the big question then is, what is the multiple? That's obviously a big question, and that really is a profession in itself, and you need a valuation expert to calculate that for your business. However, Gerry is going to give us some insights into factors that influence that multiple, and how that multiple potentially could be increased for your business. So over to you, Gerry.
Thanks, Joe. So this graph gives us a theory, which is that essentially we've got EBITDA, or you could look at sales revenue if you wanted. The same thing applies really, across the bottom, and enterprise value up the side, and we can see that it's not just a straight line, it's actually an exponential curve. And what this means is that as the multiple, as EBITDA increases, the multiple increases as well, which means, in simple terms, it means the bigger you get, the faster your enterprise value grows. Now, what happens when we look at the actual data? And we can see that this is telling us a very similar story. We've just picked on the industrial sector deals up to about 30 million, and had a look at this data, and it's very, very interesting to look at it, and you can see that it's really telling us exactly the same story, which is that as business size and profitability increases, so does the multiple, which means that your enterprise value actually increases even faster, which gives you the curve that we can see there on the graph. The other interesting thing, just in pulling out this data and having a look at it, and this graph is actually looking at the same data in a slightly different way, with enterprise value across the bottom. In other words, what these businesses sold for, and the multiple that they achieved up the side. And interestingly, as you can see, there's a huge amount of variability, particularly on the left-hand side of the graph with the smaller deals, which then narrows down as we get across to the bigger deals on the right-hand side. So if you look at, for example, take the 10 million enterprise value line, you can see the multiples are varying anywhere between about 4 and about 14, which is a huge amount of variation in there. But I think whereas once you get to the bigger businesses, it's obviously a lot more consistent and a lot more predictable. I think what we take from this is that achieving a certain multiple for your business is not just you might say, an automatic thing. Multiples do vary incredibly widely depending on all sorts of factors, which can actually be quite intangible. In the mind of the acquirer, are you a desirable target or not? And there's all kinds of things that can influence that, which Joe's going to touch on later, and we're going to drill into in quite a bit more detail in the second part to this series. But the interesting thing is, if we look towards the left-hand side of this graph, in actual fact, if you are really well prepared and well positioned, even a small business could achieve quite impressive multiples, and perhaps even higher than some of the bigger deals in the marketplace. So it just shows the power of being prepared, doing your groundwork, making sure that you're in a good position. So what do these typical acquirers look like, and what do they look for? Well, as with lots of things in the subject, is a broad question. It's a big subject, and they come in all kinds of shapes and sizes. But the biggest acquirers are corporate buyers. In other words, big businesses that are buying small businesses. They've got huge acquisition budgets. The interesting thing is that a lot of small businesses are familiar with what we call organic growth, which is essentially doing more of what you're doing at the moment, growing what you've got already, taking on new customers, marketing, and so on. Bigger organizations grow by both organic growth and acquisition. In other words, gobbling up, you might say, gobbling up the smaller players in the market is a key part of their growth strategy. So it's something they're doing all the time. They've got big budgets, they've got teams of people that understand what it's all about, they're very experienced, they know exactly what they're looking for. And you will find that it's very difficult to pull the wool over their eyes. You know, they will make sure they've got a really good understanding of what they're buying. So starting early to prepare your business, get your ship in order, get a good understanding of what they're looking for. It's hugely important in terms of what the final outcome looks like. So just to help illustrate this point, Joe's now going to take us through a couple of very interesting case studies. I think you'll find this interesting. Companies that have sold recently in the same industry sector, and how these compared, and the very interesting similarities and differences between them. So I'll hand over to you, Joe, to take us through those, if that's okay.
Thank you, Gerry. That was helpful what you've gone over. And now on to the case studies. So what we've done here is we've done quite a bit of research and found two case studies that were really similar in some respects, but obviously differing in other respects. Interestingly, they're both packaging businesses that have sold comparatively recently, and they both actually sold to the same acquirer. So in that sense, there's a lot of synergies there. You couldn't get anything more similar to compare in terms of the actual sector of the market, and also the acquirer being the same. So just for the record, obviously we want to preserve confidentiality, although some of the data is available on Companies House and so on. Just for the record, these are not clients. Obviously we wouldn't divulge clients' information. It's data that's made publicly available, data on Companies House and so on, data that we've got access to. So with that case study number one, we've obviously changed the names of the companies concerned as well. So we called them ABC and XYZ. So just change the names there. So the first case study was a packaging business, like I've said, sales of 5.4 million, that's the turnover, gross profit of 25.8%, and an EBITDA of 507,000. And also you'll notice we've put in the percentage of EBITDA in relation to sales, which is important, and that does have a bearing on the multiple that might be used. In this particular case, it sold for a multiple of 5.38, and that meant that the actual transaction was 2.73 million. So it sold for 2.73 million. That's the total enterprise value for ABC Packaging Limited. Now on to the next one, XYZ Packaging. You can see the sales were slightly higher there, 13.2 million. Although they're selling the same, broadly the same kind of goods, packaging again. The gross profit for that business was actually 43.7%, and an EBITDA of nearly 2.1 million, which importantly was actually 15.8% of sales. So that achieved a multiple of 8.72 and realized a value, total value of 18.3 million. If you put those two case studies side by side on a table, which should be coming up on the screen there, just gives us an interesting comparison, and we can then make some interesting comments on that when we see them side by side. First thing you'll notice straight away is the size of the enterprise. You know, obviously XYZ Limited was 2.5 times the size in terms of revenue. Gross profit was clearly much better, 43% instead of 25.8. That's another factor that any buyer would take into account. The EBITDA percentage was clearly a lot higher at 15.8%, higher than the 9.3%. Again, that makes it a lot more attractive for any potential acquirer, resulting in a higher multiple. You can see that, instead of a multiple of 5, multiple of nearly 9 times the EBITDA was used in that case. And then obviously that, as we've seen on the graph earlier that Jerry showed, that it's exponential, the actual value realized going up from 2.73 million to 18.3. Another interesting factor to throw in there's the debtor days. ABC Packaging were clearly having some challenges collecting their debts, 60 days, whereas XYZ Packaging appeared to have that under tighter control at 50 days. Anyway, in summary, for a business that was 2.5 times bigger, XYZ Packaging was 2.5 times bigger than ABC, but the amount realized, the total deal value, the amount of cash that actually changed hands on completion day, was actually 6.7 times greater, so nearly 7 times more valuable. So hopefully we found that interesting, that it's more than just about turnover, it's more than just size, but size does enter into it. It's very interesting. So these are interesting case studies. Moving on to a few other factors that we noticed as well when we were drilling into these in a bit more detail. We did a bit of research on it. In ABC, the husband and wife were the only directors and shareholders, and they were both in their late 60s. So that business was probably very owner dependent. Both those people were working in the business and really the only ones providing the leadership and so on. Not only that, but they both wanted to retire and pull out of the business as soon as possible. So not only if you've got a small leadership team, they want to get out quickly. Also, the low gross profit margin, as we've flagged up already, is a weakness of ABC Packaging. And the high debtor days may well have pointed to lower quality customers. And that's a big point. When a buyer comes along, they're very interested in the quality of the customers that they're going to get the goodwill of. And then XYZ Packaging, in contrast, had 6 directors working in the business, 6 actual working directors, 5 of which wanted to remain on the board and remain in the company following the sale. So a much stronger business model there. They were profitable and growing. Notice that that's an interesting and important fact, that a growing business will attract a higher multiple. They had a very healthy gross profit margin. Even after factoring in a lot of direct costs, their margin was still nearly 44%. And they had well-managed debtors. So some contrasts there and some extra reasons why XYZ Packaging achieved a higher multiple and a very healthy sale price. So these are interesting case studies. Bear in mind that there's so many factors that influence this. In our next event, the part 2 of this series, we'll be drilling in to some of those extra factors. So stay tuned. Some of those extra factors that will really make a difference in more detail in your business. If you've got any questions, please can you put them into the chat box. We won't be answering those right now or today, but we will try and weave in some answers into the part 2 of the series. So if you want to keep them confidential, just choose hosts and panelists in the chat function, and we can pick those up. We'll leave the webinar running for a few minutes at the end, so you've got plenty of time to post your questions. So stay tuned for the next session. And now Jerry's going to give us some key takeaways from this session. Thank you, Jerry.
Thanks, Joe. I think it's very, very interesting to see those 2 case studies side by side and see what the real impact of some of those differences really is in terms of business value. So some key takeaways from this first session. Firstly, get a good understanding of how business value is determined and what levers impact this. Secondly, be aware that buyers, big corporate buyers, are savvy and experienced. They do know what they're doing. Do your groundwork early and be prepared for everything to be scrutinised, and I don't think that's an overstatement. Get to know, finally, what there is about your business that will either attract on the one hand or repel a buyer, and make sure you build it into your strategic plans. An objective to either remove or improve those negative factors. And as Joe's touched on already, we will be drilling down into that point in a lot more detail in the second part to this series, which you should all have been registered onto that automatically by registering for the first event. So make sure you watch out for that. There will be a link coming through in the next few weeks, and that's coming through shortly. Make sure you make time to come onto that, because I think you'll find some interesting insights into what kind of factors impact business value and how you should factor those into your own business plans. So with that, that brings this event to a close. We'll just leave the webinar running for a few minutes, just to give you a chance to put any questions on there that you might think of. Thank you again for attending. We're glad to see you all again virtually, and we look forward to seeing you all again soon. Have a very good afternoon. Thank you.